Uh, Firstly, thanks everyone for their time. These are strange days, very strange days, and I appreciate that you're busy and no doubt flat out with clients and all sorts of other requests. So we really appreciate your listening and your interest. And as Adam said, feel free to shoot any questions on stocks, markets, or anything as we go. We've got a presentation. I'm just going to sort of fly through some of the introductory stuff. So page 2, just it's a very quick reminder of the fact that nothing has changed. So Steve Black and I have run this fund for over 15 years, and the team is the same. We've never had anyone else other than us running the fund, and the process is the same as it was drawn up day one. And no matter what markets throw at us, those things certainly haven't changed and won't change. And this is really, there's a lot in common here with what happened in the GFC and our behaviour in the GFC. We'll talk about, and also talk about our behaviour and our sort of approach during these kind of uncertain times. And just keep in mind also that we're still very heavily invested in the fund, so that's never that hasn't changed. Slide 3 talks about performance. Obviously, this is to the end of February. We haven't finished March yet, and rest assured the numbers will change in March. There's nowhere to hide in this market. But you can, and so we don't want to dwell on this too much because it's not really that relevant. We had a very good year. The 12 months were up at 5 and 9% versus the indices, but times have changed. And then slide 4 just shows you the longer term track record of accumulating value versus the index over and through many different market cycles over the last 15 years. So slide 5 is really where we're to the nub of it now. What's happening now? What do we understand about it? What can we not understand about it? And more importantly, how are we reacting? Everyone knows what's going on at the market level. We've had the sharpest sell-off in less than a month for a number of years, much sharper than the GFC. The news changes by the hour, and we're not going to try and predict the news. That's not our job. The economy is definitely going to take a hit. It's unquantifiable at this stage, the depth and the length of the recession. And one of the big swing factors, we all know the bad news, but one of the big swing factors that cannot be quantified right now is the extent to which government action will actually offset any weakness. And we don't even know how long the weakness is going to be. But one comment I would make is that QE was announced within 3 or 4 weeks of this problem. If you cast your mind back to what happened in the GFC, it was about an 18-month bear market. QE came through in the 15th of the 18 months. So the government was much, much slower. They watched a lot happen before in the GFC before they pulled the trigger on these things. You can see what's happening in the US and globally now. It's very aggressive, and it also is growing by the day. No doubt you'll hear more in the next 2 or 3 weeks or whatever period of time this goes for as to the extent to which governments will do whatever it takes in inverted commas. From here, the markets, obviously the credit markets are a real wild card. We kind of know the economy is going to struggle. We know the government spending to offset that. We know interest rates have been pushed down lower. The oil price shock is a concern to the extent that it pushes a lot of oil producers into basically bankruptcy, whether or not that upsets the debt markets. And I think QE is more about debt markets than anything else at the moment. We'll wait and see. That just sits there as an unknown at the moment, but could further add to risk. And rest assured, in this market, what's happened in the last 6 weeks or 5 weeks is not the perfect environment for stock pickers like us. And I'm not using that as an excuse, but there is literally, it's like a bushfire. It's chaos, and it will settle, and stock picking will come back into, will start to actually sort of normalise. Slide 6 shows you just how bad this has been in a historical sense. This is every year back to 1825. So nearly 200 years of the equity market, and we are, the year to date, we are already in the way to the left as to the performance of the market. So it just shows you how quickly this has happened, and in a historical sense, just how painful it is. But that's from today's price, so that's not necessarily a prediction at all from here. It's just an observation of how quickly the water's changed. Slide 7 just sort of talks about the impact on our fund. So since the market peaked in February, on the 20th of February, and the small cap market is off 30 odd %, and so is the Dow Jones. Over that period of time, we've underperformed mildly, But it changes by the day. There are days when we've been up 100, 200 points, down 200 points versus the index. It is quite literally not fruitful at all to try and pick a trend or any reading as to the daily movements right now. So, and that's not just because the markets are weak, but in small caps, things tend to be even more chaotic because you get, with lower liquidity, you often get things like there might be a fund who's lost a mandate, or indeed a small cap fund that has been liquidated, and we kind of think we know of at least one, and there's probably going to be more. That adds to the indiscriminate selling. It's taken out of their hands. You see quant funds are wired to sell once a downgrade comes through. So if downgrade X comes through, irrespective of how short-term that impact is, then those quant funds literally push a button. It's an automated process. So that again adds to the volatility. But it's safe to say that, you know, the microcaps have been hit harder. They always do. Market-linked stocks, and we listed a couple there. So we talk about some of our worst hit stocks there. Charter Hall and Moelis are definitely linked to the markets, and they've certainly underperformed. And cyclical stocks, so Emeco and Seven Group, which are small positions of ours, they have certainly been hit as well. And City Chic, which is the online retailer. Conversely, the best stocks, there are certain stocks which have zero, so literally no impact whatsoever from any economic or health issues, and they have outperformed dramatically by not falling, frankly. But the poster child in our portfolio in the last 6 weeks has been Fisher and Paykel Healthcare, which is 3% of our fund. They make respirators, and there's never been a better time to be making respirators. The main freight is a large international freight forwarding company. They deal in largely non-discretionary items, so whatever they are moving will be bought and sold every day, irrespective of economic cycles. Oz Brokers, they sell insurance to small and mid-sized companies, and the one thing you will do if you're in business is pay your insurance. Now, we are certainly going to see some decay in their customer base, but it is largely protected. Johns Lyng is the largest, in a very fragmented market, the largest group who does post-insurance repairs. So just picture you've had a hailstorm or your roof has caved in during a flood. They are the ones called out to repair it. And again, there's no cyclicality there. And I'm happy to take questions on on any stocks we talk about, but I'll just move from there into the next slide. So slide 8 just talks through the outlook from here, and certainly don't lean on me or anyone to tell you what the immediate outlook here is, because we don't know. We don't know how far this goes, the disease and the economic impacts. We've given you 3 scenarios there. It's really not to tell you that we know anything other than the longer it takes to cure, to lock the economies down and find a cure, the worse this gets. But you can build scenarios where lockdowns they will finish, and potentially earlier than people expect, and there might be a vaccine or a cure, and you might actually see that because of the sheer force of money being thrown at the cushion effect by governments and interest rates, the trough could actually be quite shallow. Who knows? Time will tell there. We're certainly not building a portfolio around any one of those 3 scenarios. We're building a portfolio over the heightened earnings risk at the moment, and the need to be aware of that with our positioning. So now we move to slide 9, headed "What are we doing?" So basically, at the moment, this thing's been quite breathtaking, the speed with which it's happened. Steve and I have been incredibly busy, not only getting our heads around it, but making necessary changes and prioritising, and as much as we can, ignoring noise. There's never been a noisier market. You can imagine headlines and dealers calling us and rumours and this, that and the other. It's so important now, more than any other time, to ignore noise and to drill down on what the actual facts are. And so, in a summary sense, we've made some pretty decent changes to our portfolio. We've removed as much cyclicality as we can, and we have, even though some of those stocks have underperformed, we've removed stock-specific risk. So we've trimmed the maximum size of the positions in our portfolio marginally. And most of the work at the moment we're doing is on balance sheets. So we looked at Webjet 3 weeks ago. We thought, well, hang on, here we go. If travel is banned, it will come back at some point. Webjet was down about 60% at that point. So it seemed to us at first glance to be saying at this current share price, it's now trading on about a third of the valuation, assuming volumes go back to normal. and that's fine. And so we built that proposition and then did some interrogation on the balance sheet and realised that they are actually owed money, that's $317 million, by travel agents. And the unfortunate fact is a lot of those travel agents, and they're overseas, a lot of them will go broke. So Webjet is actually a bank. It lends money to travel agents. They won't get paid back. Webjet, we very quickly realised that Webjet is potentially bankrupt, and so avoided it. And we had a small holding in Flight Centre, which is a much more conservatively positioned travel stock. We only had just established that position on the basis that it was oversold. Sold that immediately as well, acted very quickly. Webjet has gone into trading halt. They're trying to raise $250 million. They've failed twice through 2 different brokers, and I wonder if they're ever going to trade again. And that's not, so if it didn't have a problem with its balance sheet, it would absolutely have been a great stock to play for the fact that it was oversold in a travel ban that will be lifted at some point. So that's where most of our work's been done. As I mentioned, we need to acknowledge that certain stocks are going to have earnings their earnings will fall. Try and figure out how much of that is already baked into the share price, which is in most cases fallen much more than the market. But more importantly, it's all very well to look through a valley of earnings and price a stock off what a recovery might look like, but if they die in the meantime, it's worthless. So it's all about making sure we are only at the margin, and we're not investing in many cyclical stocks at all, but we're investing in those that can actually survive. And that sort of stuff is, we have direct contact with CEOs. So when I talk about gathering information and ignoring noise, most of what we're doing is talking to people about actual facts, about balance sheets, about leverage within P&Ls and those sorts of things to understand how we can derive some sort of decent valuation in all this noise, or a valuation with a grounding. Capital raisings will come thick and fast now. So we've moved our positioning, our weight in cash. We have a limit of 10%. It's sitting just below 10% now, and we don't really ever have it more than sort of 3%. We use it as a bit of a transactional thing because we're fully invested. For us, it's good to have the capacity to potentially act quickly if there are capital raisings in companies that we actually know and understand and trust, who have for one reason or another just been pushed into a situation they don't want to be in. And if someone told you 6 weeks ago that Cochlear would have an emergency capital raising, there is not a single person that would have believed you in markets, but it did happen. We're ready. Those capital raisings were a sensational part of our recovery after the GFC, and it's because people basically boards are forced to dilute the hell out of existing shareholders, and it's to the benefit of the new shareholders. We're very wary of buying things just because they've fallen, and equally wary of stocks that are bouncing quickly that sort of appear to be repaired. When we were moving through the GFC, we watched ABC Learning and Babcock and Brown both double on a number of occasions on the way down, so 100% share price increase. They both ended up at zero. They're just distractions. This sort of volatility is we've got to maintain a very level head and be disciplined. And we make the point juggling chainsaws. Really, if the market rallies 25% from here, and I would believe anything now, if that happens, you would expect our fund to underperform only because the bear market rallies are always, they're classic, they're known as junk rallies. So if anyone's outperforming a bear market rally, they are technically juggling chainsaws. It looks impressive, but there's a lot of downside if you get it wrong. There's a few stocks we've bought and sold. So you can see Unity Group is a small telco. They resell NBN, and rest assured, demand for telecommunications, you all know. You're probably sitting at home. You probably know this anyway. Steadfast is the other large insurance broker. Not insurance company. Propel Funerals speaks for itself, although the share price has been slammed because there's a limit on people, attending funerals. That limit will actually lift, guaranteed. Their balance sheet is fine. The stock price is off about 20% in 2 weeks because of that. That to us is just a classic distraction, people losing their nerve and selling without thinking. PSI Insurance is another insurance broker. And you can see a few sales there, just companies that we didn't trust their balance sheets or their ability to travel the valley. And Viva Leisure is a gym company. Gyms are closed. Unfortunately, that company is going to really struggle to pay its leases. We're happy to get out. Slide 10 is these are a couple of throwaway thoughts about how much. So markets over the long term are really driven by earnings and the comparative rate of return you can get from another investment. So bond rates is your best point of reference. There's one other factor, or two other factors that are less quantifiable. Emotion absolutely is a factor, and this is where markets become completely inefficient. And it's the same as at the top of the tech boom. That was emotion that drove it, and it was inefficient. It was well overpriced. And there's nothing more. And then if you add to that illiquidity, which is the factor in the small cap market, the last factor that drives the individual share prices, emotion plus illiquidity means that share prices will move up and down in much more exaggerated fashions. To us, that's a description of some of the pain we're feeling at the moment, but that'll level out. Mostly, it's a description of the opportunity we can see over the next 6 to 12 months, where people really do lose their nerve, and we can buy things at very, very deep discounts. So the best way to sort of express some of this, and everyone's feeling it at the moment, we're not looking to simplify the human reaction or talk it down, the human reaction to what's going on. But I know one thing: you'll never read a headline that says over the last, as in capitals, you'll never see it in the newspaper over the last 6 months. $100 billion was quietly created during the share market, but you will absolutely see if it's 20 billion down in a day, that is a headline. It's a classic thing, and it rattles the average punter out there who will quite often ring their planner with a sense of panic, and those actions can in themselves create further weakness. We also make the point that volatility is a distraction like no other, and imagine if you knew during every day what your house was worth, if it was listed. And I know it's a stupid thing to say, but the fact that it's not listed means you're not thinking about it. People overthink short term, particularly in the equity markets when things are like this, and they think that things that fall can only get worse, and they sell them. And you certainly wouldn't behave that way if you're a long-term investor in your own home, and it's not how we think. So, but we're as I said, we're ready to go. So what to expect from a recovery? Slide 11, I'll just make some observations. This is more in a broader sense, a roadmap, and I'm not calling a recovery right now at all, but this is what, this is just some sort of building blocks to think how markets would behave at the point in time where we've seen the worst in share prices. And the one thing that when the markets are making their lows and it's time to actually not sell or indeed buy, no one will ring a bell for you. No one will make it easy. And in fact, at that point in time, the news flow will be absolutely at its worst. So an example with the GFC, the markets made their lows in March 2009. The US economy was tanking. Lehman's had been broke for 5 months at that point in time. Activity in the US was absolutely being vaporized. That news flow about jobs, so unemployment increased all through 2009, calendar year 2009, and economic activity remained negative all through 2009. And if you waited for the point where there was proof that the economy had bottomed and was recovering, that came out in February 2010 with the first GDP reading that was positive. At that point in time, the Dow Jones was up 57% from the lows. That's very hard to make up. And frankly, we, at the time, Steve and I were running our fund, and our touch wood, we don't see that many redemptions in this cycle. Last cycle, we didn't actually see many redemptions. Most people understood that long-term investing does have bumps in the road, but we did have 2 or 3 planning firms and a couple of, including a family member of mine as well, and I'll never let them forget this, take their money out of the lows. And what they missed is, it was just they hit their pain threshold of volatility. And at that point in time, so from that point in time, our fund was up 70% in the 12 months after. The small cap market in Australia in the 12 months was up 64%. And, that's, as I said, if you're a long-term investor trying to make up missing 1 year of 64% or 70% is almost impossible. So we talk about, in slide 12, I'll try and make this simple. The bars are the US GDP. The red line is the Dow Jones. And you can see the Dow Jones, when it made its lows in March 2009, at that point in time, investors were still uncertain as to any sense of recovery in the economy. And indeed, as the Dow Jones rose 57%, you had 3 more quarterly readings of massively negative GDP, 3-4%. So I guess I repeat the point that when markets recover, it's always when the news is still very, very bad. And I'm not, as I said, I'm not here to tell you when that would happen, but it will be a feature. It's the feature of every market recovery. It always predicts rather than waits for confirmation of recovery. Page 14. Actually, sorry, there's one other chart there. Where's the small cap one? So I'll just take you to page 13. Sorry. And that is that in the context of any recovery in markets, when and if they happen, and sorry, when they happen, we just don't know how low or if it's starting to happen now, small companies tend to underperform, and they definitely have underperformed in this very, very sharp turn down now. So the small ordinaries are off much more, sorry, it's about 35% versus 31% for the large caps. The point is that from the lows in every recession, and the chart shows you all the recessions in the US back to the 80s, from the lows, the small cap market, well, firstly, the markets make their lows before the recession has ended. It's roughly 6 months before. And then the small cap market usually has every time bounced much, much harder than the large caps. And it's because they fell further. And liquidity, this is why liquidity it's a great reminder of the dangers and the benefits potentially of liquidity if you're buying from people who are panic selling. But, you know, as you can see, in March 09, the US market over a 12-month period rose 59%. Small caps were up 84%. So these are huge moves. And I'm not suggesting anyone try and trade around them, but it's just a reminder of the danger of exiting markets when the pain threshold on the news flow gets too much. Slide 14 now. I'll just before we talk about 2 or 3 stocks, it's just a reminder, if you don't mind, that we have some competitive advantages, we think, in a market like this. I guess there's a few things here that aren't that easy to describe to outside investors, but hopefully we get this across. Steve and I have only ever done small cap industrials. We've both been doing them for 25 years. We've worked as a team together here for almost 16 years. Without any external, any other analysts or any other external input. That tenure and understanding how each other thinks is very important. We had a pretty hairy week last week, as you can imagine. I think everyone did. And we had conversations where we had to make reasonably quick decisions on things that we had agreed were good, and all of a sudden they looked bad. And those changes in direction when they're required are often tense. And if you don't know someone and you haven't worked with them for a long time, it can actually be terminal. Its emotions can get the better of you. So thankfully, having worked together through the GFC, those sorts of emotions are not part of what we do. We can afford to be pretty clinical. And also the fact that we are a small team, there's only 2 of us. We don't. Other inefficiencies come in big teams where there's a whole lot of people to convince and a whole lot of disparate ideas and indeed emotions taking over. It's very hard to coordinate a large investment committee, whereas 2 people can actually make reasonably quick decisions when they're needed. We don't run any other funds, so Steve and I only run one thing. It's the Emerging Companies Fund. There's no other distractions. Pengana's not pulling us away from it in any direction at all. And we have low FUM, so we've always, hopefully those who are on the call know that we shut the fund 8 years ago. We've always said we'll manage a fund that's smaller than a lot of small cap funds, and some of them are 2 or 3 times as big. Now, very large funds in small caps cannot make decisions. They cannot correct their errors straight away. There's just not the liquidity. And being able to shuffle out of a few of our positions in the last week without too much market impact has been a huge benefit to us. And the other point I'd make is that Steve and I have always avoided group briefings. We get 95% of the companies we meet face-to-face in one-on-one situations, which obviously 2-on-1, but anyway, they're more, and that involves building a relationship. If you're going to group briefings where you're one of 15 investors, you don't actually get to know the CEO. You don't get that sort of, I don't want to say intimacy, but you don't get that sort of relationship building up. Because we do have these strong relationships, we're able to pick up the phone. They know exactly who we are. We're the ones that inquire deeply and show interest in their businesses. And so we're actually, and Steve and I have got a list as long as your arm at the moment, and we're sort of halfway through talking to CEOs, making sure we understand balance sheets. We actually get direct access, and that's something that, again, you can't quantify, but I know it's, having been a broker in the small cap world for 10 years prior to this, I know that it's not the case with all fund managers. So I'm going to give you three discussion points on discussion companies that we have increased our holdings in the last week, and then I'll throw open to questions. Again, these are just great examples of when the market goes into complete chaos and you get the bushfire effect, and there's just panic, liquidity, chaotic moves. Then very calmly you can actually take advantage of these moves. Cleanaway Industries is a company we've always had a shareholding in. It's just been completely flogged it's down 25% in the last, I think, about 2 weeks. Excuse me, and we've been able to buy more. We bought more yesterday. More than happy to. These guys are, to state the obvious, they're the largest collector of your household rubbish around Australia. They also have marginal, and so that there's almost nothing that will alter the rate of rubbish creation at the home level. And in fact, given how busy Uber Eats is at the moment, you're probably throwing out more waste, but it doesn't matter. They drive past your house once a week, and that is not in any way affected by the economic cycle. They have a very small exposure to collecting rubbish from restaurants, and you can imagine that is actually under pressure. Hence, there's 25% fall in the share price. We can look at the leverage there and understand that it's not going to send earnings down 50%. It might send it down 5, maybe 10. But with the share price of 25%, we're more than happy to be taking that on. It's a very well-run business. The balance sheet is stable. Slide 16. Another classic case of a company with very strong defensive earnings that has been sold down enough for us to, and we had been selling actually not that long ago. So in February, in better times, we had, because the stock had done very well, we'd reduced our position in the company, and just yesterday we were able to top it up pretty handsomely. IPH Group is the largest provider of trademark and patent services, so it's a patent attorney. It's very, right now the word boring is a massive compliment for companies. It's a very boring, stable business. They have very, very low churn. So and most of their revenue is generated in US dollars. So most of their clients just think it might be Apple comes up with the iPad 7 or whatever it is, that has to be protected all through Asia, through Australia. They've had relationships with, and IP protection is such a small charge compared to the price of the R&D in the first place. They don't tend to shop around. They tend to just send it to the same person. It's procedural. These guys are very efficient, very high margins, and with the fall in the Aussie dollar, their pricing has actually had a major increase. And through the GFC, this company proved there's very, very, very little impact on the rate at which people register trademarks and maintain them. Very well managed, and as we mentioned there, it's down 31%, so we're happy buyers. And then the last one on slide 17 is Clover Corporation. This is a pretty small position of ours because the stock is not, so Cleanaway and IPH are 3 or 4% of our portfolio. This is 1.5%. And take from that it's certainly riskier, but not completely, not as risky as most in this market. The stock has fallen, it's basically halved in the last 6 weeks. They are the largest provider of omega-3 additives into the infant formula market. And omega-3 is just simply taking tuna oil, which is a waste product, and making it into a powder, a flavourless powder, and injecting it into infant formula and tablets and bread and all sorts of other things. 80% of their volume is into infant formula. Their competitive advantage is that it is truly odor-free, so there's no kickback, and there's also they can have their concentration levels are far in excess of their largest of any of their competitors. It's largely a backyard industry, which is why most of the large infant formula players in the world actually use them. There's people like Danone, these are massive companies, and so the fact that they found this Aussie business, they know through the world that these guys are the best at what they do. Now, there's regulations in Europe, even China, with a minimum concentration in any infant formula product. You have to have a minimum level of omega-3. In Europe, it's just gone from 10 milligrams to 20. In China, it's about 10, and there's the sense that it will go to 15 or 20 pretty soon. As I said, you're not compliant unless you're using this product. You just think about it. Doesn't, you know, China, we've just had that, they're almost through this virus. Touch wood, they don't go again, but they're almost through this virus. And throughout the whole disruption in China, infant formula sales have remained stable. You've got to feed your kids, it's to state the obvious. So these guys are very, very well positioned in a global industry that's growing. The Chinese government did want to, they were promoting local producers of infant formula versus all the global players, and it just hasn't worked. So Clover is on the coattails of all these huge companies that are taking share in a very large, very stable market. And as I said, the stock's off 54% in the last 6 weeks. So that we were very happy to buy more yesterday on that weakness after the result came out. It showed they're still growing very strongly. So what I'll do, I'll hand it over now. As Adam said, Steve's here as well. He's going to answer some questions. We're happy to throw around anything at the market level, anything about stocks, anything we do own or don't own, and I'll leave it up to Adam to coordinate questions.